More on the markets and what you should do now with these mixed signals. Ben Emons from Medley Global Advisors and Charlie Bobrinskoy from Ariel Investments. Charlie was going to start the conversation by asking you if Fed Chair Jay Powell reignited the bear market. And now we're seeing this nice turnaround in the market today. But what do you think about those comments and the direction?
Well, as we've discussed, he obviously was embarrassed. The whole Federal Reserve was embarrassed for having messed up the inflation situation, having denied that there was inflation and then said it was transitory, and then it obviously wasn't transitory. So they're trying to catch up, and they are worried that the market's not taking them seriously. And so he went out of his way to say, don't look for a pivot. We still have raising rates to do. And as we've also discussed, higher interest rates have different effects on different parts of the market. Higher interest rates are much tougher on growth stocks whose earnings are way in the distant future than they are on value stocks whose cash flows are much closer in. And so we're seeing that disparate impact on the market, with value doing much better than growth
today. But if we go into a recession, if we stop worrying about inflation and go into a recession as a result of what the Fed is doing, then that's not good for value.
No, you're absolutely right. And that is why I'm not so enthusiastic about what the Fed is doing. We are not having the inflation that we're having because of an overheated economy. That's just wrong. The economy is bumping along here with no growth for the last 2 years. As you and I have talked, we're having all this inflation because the money supply went up by 42%. We had massive deficit spending. The Federal Reserve monetized those deficits, and that's what caused this recession. And so the Fed has one hammer. Every problem looks like a nail to them. And so they're trying to increase interest rates. And unfortunately, that wasn't the cause of this, an overheated economy.
Ben, how are you balancing all of these risk factors now? Inflation, higher rates, potential recession, and a market that today is proving somewhat resilient after a big sell-off last week.
Yeah, I think I echo the other guests' comments. You could take the Powell speech and extrapolate Fed policy into next year, and you can come up with a pretty high Fed funds rate if you factor in QT. So if you actually know that, then you can also build out a bit of a portfolio that is quite balanced. I find it striking that the equal-weighted S&P continues to outperform the S&P for the year, whereas anything that you try to do with downside or any type of high beta does not. So clearly, the market wants to be defensive as you get this tightening on the way, and that's what's showing today too. In the aftermath of Powell, what performs well? It's either materials or staples or anything in, let's say, technology that is actually not so sensitive to interest rates. I think this is the way to play this environment as the Fed continues to ramp up, and we still deal with high inflation that's now still quite sticky.